Are you going to be buying a home soon, or you simply need to renew your mortgage? Well, you might be seeing these fixed rate mortgages compared to the variable rate mortgages, and you're wondering, is it a good idea to take a fixed rate mortgage right now? I mean, the rate is better, so it must be, right? Well, not necessarily. My name is Jarrett with White Ridge Mortgage, and today we're going to discuss what actually is the best option to choose between fixed and variable, especially right now in a rate environment that is slowly going down. Now, before I get into the video, please hit that subscribe button, like this video. It does go a long way in supporting this channel, and it really motivates me to produce more videos just like this and find ways to add more value. Okay, so let's get right into the details you guys have been waiting for. Is a fixed rate mortgage really a good idea right now? Well, let's think about it. The current 5-year fixed rates are on average about 4.75%. And if you wanted to take a bit shorter of a term, such as a 3-year fix, which has been a very popular option lately, it would be around 5%. Variable, on the other hand, is currently prime minus 0.95, which is a pretty solid discount of the prime rate. Now, what does that even mean? Well, a discount on prime rate, that essentially means that when you're getting a variable rate mortgage, your contract doesn't actually state an interest rate on it. Instead, it has a discount stated on it. The variable rate is based on the Bank of Canada prime rate, and every single year the Bank of Canada has 8 meetings where they discuss what they want to do with that rate, whether it's increase it, decrease it, or keep it the same. Now, if the prime rate goes down, the rate you pay on your mortgage will also go down. If prime rate goes up, the rate that you pay on your mortgage will also go up. You will always keep that discount lower than prime. So if prime rate now is 6.95, and they lower it to 6.5 and you have a 0.95% discount, your new rate would be 5.55. So back to the fixed rates. A $100,000 mortgage at 4.75 over 25 years is about $567 a month. Same kind of mortgage for a 5% rate over 25 years is $581. And finally, the same kind of mortgage over 6%, which would be your variable rate, is $639. So to clarify, per $100,000 you borrow, you're saving about $14 per month by taking the 5-year term, and $72 a month by taking the 5-year fixed rate in comparison to the variable rate. Now that can add up, considering if you have a $400,000 mortgage, that $72 monthly actually turns into about $288 a month, and over the course of 1 year, that's $3,456, and over 5 years, $17,280. However, does that really mean it's the best choice? Well, not necessarily, because there's many different variables that come into play that could save you tens of thousands of dollars by choosing the variable rate mortgage over the fixed. But guess what? There's no crystal ball, and that is why I am here to provide you with some considerations before taking your fixed rate mortgage so you can choose the product that actually suits you best. The first one you want to consider is that you have the option to lock in your variable rate mortgage to the current fixed rate mortgages at any point in time throughout your term, to the same term or one that's longer with absolutely no penalty. This means if you have 5 years remaining, you can lock into the bank's current 5-year fixed rate terms. If you had 4 years left, you could lock into 4 or 5-year terms. If you had 3 years left, you could lock into 3, 4, or 5-year terms, and so on. This is very important to know because with the rate environment we're in, fixed rates could potentially be 0.1 to 0.2% literally a month from now, and could definitely be much lower than that by the end of your fixed rate term if you were to choose that from the very beginning. It is becoming increasingly popular for people to choose a variable rate, not because they want to stay in a variable, but it's a way to prolong obtaining their fixed rate mortgage. Now, if you think about it, if you're paying $72 per month per $100,000 you're borrowing, and you had about a $400,000 mortgage, in 2 months that would be $576 in additional costs, but then you might be locking into a rate of 4.5%, which in turn is $14 cheaper per 100K you're borrowing, and over the span of 5 years, that savings amounts to $3,248. Now, once you subtract that $576 that you were saving, you're kind of left with $2,672, which is quite a bit less than if you were to just take a fixed rate right from the beginning. Also important to factor in that economists are predicting that rates will come down nearly 2 full percentage points over the next 2 years. Now, the second reason why you'll want to consider the variable rate mortgage as a possible option is due to the penalty for paying out the mortgage early. You only ever pay a 3-month interest penalty if you're paying out a variable rate mortgage early. This essentially means whatever your monthly payment is, you take the interest portion of that and you're only paying 3 times that. This is substantially lower than the penalty you would pay if you needed to break a fixed rate mortgage from the bank. Now let's take a look at what that actually looks like. Fixed rate mortgages use what's called the interest rate differential penalty. I know it's a very complex term, but essentially it's the interest the bank would have made for the remaining amount of time in the term compared to the current rates they're offering at the time of paying it out. Now, some banks even have stricter guidelines around their IRD penalty, but even in the best cases, it can be substantial. Let's take a look at how that actually works. Now, let's say you have a 5-year fixed rate mortgage at 4.75%, and 2 years in, you need to pay it out. That means you have 36 months remaining, and the current rate at that time is 4%. On a $400,000 mortgage, the payment with a 4.75% rate is $2,269 monthly, and the payment on the same mortgage at 4% would be $2,104 monthly. Now the difference between those two payments is $165. And since you have 36 months remaining, that's what you would multiply it by to get a total payment of $5,940. Now on the flip side, if you had a variable rate mortgage, well, the interest portion of that payment would only be $1,583. So with a variable, you're just multiplying that by 3, which equals $4,749. And as you can see, the penalty on the fixed rate is higher. It's not much higher, but keep in mind, that is a comparison between some of the most flexible IRD policies that some banks have and a variable rate penalty. Now, if you were to go with a major bank, their fixed rate penalty is quite substantial. It can be double, even triple in some cases, because they don't use the difference in interest between the rate you have and what you'd be going into. They go off of what's called their posted rates, which are actually about 2% higher than the rate you actually have on your contract. I've literally seen fixed rate mortgage penalties higher than $50,000 before, and I've yet to see a variable rate penalty exceed $12,000. So long story short, the penalty is much less for a variable than a fixed if you were to ever get out of it early. Now, the third thing you want to take into consideration is just the fact that we are likely going to see a massive rate drop in the overnight lending rate over these next few years. And if you take a variable rate, you can come along for that ride. It's important to have a total cost perspective and not just a month-by-month outlook. Statistically, variable rates over 5-year time periods actually have beaten out fixed rate mortgages in almost every single case, with the exception of the pandemic. Now, I would bet money that if someone went variable throughout their entire life of having a mortgage versus someone going fixed throughout their entire life of having a mortgage, the variable rate holder in every circumstance would pay less overall over the life of their mortgage, because there are decades of data that back it up. Not only that, you have to understand that the bank's goal is obviously to profit as much as possible. And as variable rates come down, even though the prime rate determining variable rate mortgage has no direct effect on the fixed rates, as the variable rates start to go down, the banks will want to retain that business and try to lock you into fixed rates, meaning they're going to try and make them a bit more appealing to get, especially the 5-year option. Now, this is going to work really well if you chose a variable rate for the purpose of locking in it later, because you could only be in that variable rate for potentially 6 months, and you already have better fixed rate options to lock down into than what you can initially get right now. With all that being said, it's safe to say that 1% to 2% rates are pretty much gone, and I'd be shocked if we even saw anything in the 2% range ever again. 3% to 4% is actually a healthy range for interest rates, and I think it's very reasonable to expect 4% rates in a year from now or a year and a half from now. And if that's the case, why settle for a higher fixed rate? Take advantage of buying now with the low purchase prices, but then still have the advantage of renegotiating that rate later on, or being able to ride the rates down. Now, of course, all this is speaking in what ifs, and we could potentially have no rates come down at all, and therefore if you think rates aren't gonna move, then great, go fixed. But if you think that we're gonna potentially see some rate drops, to get the most savings possible, you will want to consider variable, and I think you should really consider this when you're looking at these fixed rate mortgages, because people are going to be paying massive penalties later on when rates do drop to get out of them early. Now, if you want some more info on this and you want to toss some ideas or thoughts off me, you can book a call with the link in the description. If this video was helpful, please hit that subscribe button. It really does encourage me to make more videos just like this, and it would mean a lot. Thanks a lot for watching, guys. I'll catch you on the next one.